Markets are whiplashing, sentiment is fragile, and no one's quite sure what the next Trump tweet or tariff might trigger. Amid this storm, we are joined by one of India's most seasoned market minds. Manish Chokhani is director at Enam Holdings. With decades of experience navigating volatility, Manish brings a rare blend of macro clarity and market insight. We cut through the noise and ask, is this a buying opportunity or just the first wave of something bigger? And where does India fit in as the world resets its economic chessboard? Manish, welcome to the program. Thank you very much.
Thanks for having me.
As we sit down again, it's been a while.
Very wide canvas. What you've set out is stuff I hope I can address.
We'll try and sort of run through all of it. For our viewers, I just want to put out one graphic set, which kind of just, it's like a placeholder. We'll sort of put this up and throw it to Manish straight. Is this what Trump is trying to achieve? Do we know are we a little wiser as compared to where we were 10 days back? Number one, 10% universal tariffs as a revenue top-up to help the domestic tax agenda. He wants to raise revenue to be able to cut taxes later. That is number one. Second, sector tariffs aimed at bringing production home. Therefore, these sector tariffs need to be higher than 10%. And these are sectors like autos, semiconductors, and so on and so forth. He's spoken about this, pharma, of course, as well. And number three, China tariffs meant to be exorbitant, because pretty much everyone in the Trump administration kind of believes in this, that China has stolen jobs, manufacturing away, and here tariffs need to be much higher. And so then, if this is the case, those negotiations will be much more protracted. Can we say this is the Trump strategy with all that has happened over the last 7 or 8 days or so? Manish, that is my question. Do we have this much clarity now?
So I'll take a step back even from there.
Yeah.
That what is, in my view, Trump trying to do? There have been decades of US benevolence, looking after the whole world and therefore suffering the problems of the world, paying for other people's wars, becoming a home market for others with probably among the lowest tariffs in the world. And then over the last 15 years, they printed money like crazy to come out of whatever crisis they had. Their only weapon was printing the dollar. What that's resulted in is a completely warped current account, a completely warped fiscal deficit, and a decline of really American, power in the world, in military terms and so on as well. And there's been this debate for 10 years now that is the US dollar about to lose its supremacy? And everyone's been kind of pegging away at the margin to see what the alternatives can be. So what he's coming to do, I think objectively, someone needed to do it. And it's high time someone got after what they're trying to do to fix the fisc, solve the debt problem, get after current account and so on. And it's very clear, China and US are now the new adversaries. And the world may be heading into a all-out war at some point. Now, what form and shape this takes, it's not like the old days where you send tanks and millions of people into battle, but maybe this is the new form of warfare to keep the other guys suppressed and down. And the US has actually led this benevolence towards China after they brought them into the WTO and basically just abdicated their entire manufacturing prowess to them. And it's to China's credit that they've leapfrogged, taken the opportunity and become really the most dominant manufacturing as well as technology power in the world. I would say already equal, if not ahead of US already. So it's high time someone did this. From an India perspective, India was completely sidelined in this whole global chessboard. We were not in the UN Security Council. We were not ever allowed to get into WTO. Even countries around us with the chessboard which was played, which should have been a home market for us in Pakistan, Bangladesh, Nepal, Sri Lanka, were all gone. And geopolitically, we were on a back foot. We didn't have really depth in our markets. And even exporters from Bangladesh, Pakistan were doing better than, say, Indian textile companies because the rules of the game were laid out in a manner to keep kind of India held back. So in a sense, what is going on, you're going to end up, I hope, on the right side of this new drawing of the chessboard. And Secretary Bessent has already said that the first 4 deals we sign are with allies. And he used the word, we didn't, which was UK, Japan, Korea, and India. I was very intrigued to hear that because they've always said we want to bring things onshore. We want to bring things near shore, which is Mexico and others. And then we want people which are friendshore. And with India already being the GCC and the IT hub for the US, it already is like a French shoring of that in a sense for them. So in that context, the way they're laying out this new chessboard, I'm hopeful it plays out in a way which plays to India's advantage. The personal equations seem to be okay. The 3 or 4 countries which are mentioned seem to be okay. We are already part of the Quad. Now, what form and shape this takes, because there are so many moving parts, with, like he says, 75 countries coming and wanting to negotiate at the same time. And there'll be countries like Vietnam, which are very much in the China camp, but also US can't do without a lot of the product which comes out of China. So that's really that end. At the same time, China is not something one can ignore. They are our neighbors, and they are actually leaders in a lot of technologies. And Xi Jinping has reached out to try and solve the mess they made in Ladakh with us. We will be wary of them. They are wary of us. I don't know why, though, because we've never done anything really against them. But if that equation can play out where India can be a little more in the China camp, plus we have Russia, in a sense, to keep a check on China as well, and kind of, how do you say, run with the hares and hunt with the hound.
That's the
if you can pull that off,
best of both worlds.
then you would land in a really good space, because India is never going to be in the China camp for I mean, obvious reasons. It may play out over the next few decades, because one couldn't have imagined US and Russia trying to get friendly, or indeed US and Japan being allies today. I mean, 40, 50 years after they fought the most brutal war. So history changes, but in the historical context, I think things are moving in the direction of being good for India and getting us into a closer group and a more tightly knit supply chain from which we were really excluded over the last 20, 25 years.
And this will, I mean, if this were to come our way, this will come because of the posturing, much tougher sort of stance towards China that Trump and the US
clearly
has taken, right?
They can't be running this kind of deficit with China. China runs $1 trillion trade surplus. And they use the money of their surplus very wisely over the last 15 years. Ever since US started printing money post-2008, we did Narega program and we started building dollar reserves largely. China went and bought assets all over Africa largely. And they invested in hard assets. They invested in creating capacity, which today, if they are cut out from the US market, they already have ASEAN, Latin America and Africa to go to. And they can flood the world, and you can, in a way, have a deflationary boom in these countries because they can't produce this stuff anyway. And they can keep exporting their raw materials and minerals and so on to China. So in a way, China is currently, to use Trump's language, holding better cards than America. And it's really up to the Americans of how they now play this game and redraw this chessboard, as it were.
To strike a deal, we'll have to strike a deal, because you said, well, Scott Bessent said, he mentioned India as one of the 4 countries. That maybe also is because we reached out the earliest, including countries like Japan, etc. as well, because India's earlier been mentioned constantly.
Tariff king.
Tariff king, tariff king, tariff king. So we'll have to obviously give.
No, but
then, as some have said, you run a 40 billion deficit.
Prashant, remember, the tariffs in India were tariffs on products. It's not directed at US. Because of the way the WTO rules were, it's like, let's say it's a horizontal system where you're running it on product. If you had, say, a 0 tariff on automobiles, you would only be driving Chinese cars today, maybe via Vietnam or Thailand. But now that US is trying to make them vertical tariffs, which are country-specific or certain sector-specific, there's a way to change, which is why India didn't go to the RCEP. If you were part of RCEP, you would only have goods coming from the East into India. And we didn't have the wherewithal to go and export to the West. So the way this is playing out, I think, look, US is a $80,000 per capita economy. We are a $3,000 per capita economy. There are very, very few things which are going to land from the US into the Indian market which we can afford to buy. Our market really doesn't have that depth. So optically, it looks very scary when you say, oh, Harley Davidson is charged 100%. How many will you sell?
Absolutely.
You sell like 5,000 BYD cars over here. You sell like 15,000 Mercedes cars of all varieties over here. So it's not like this market is going to get flooded or has the ability to absorb that. But to kickstart an economic cycle, like it happened with Southeast Asia and China, unless you create a catalyst, which is, I create capacity which goes to the West and gives those workers the income to then kickstart local consumption, that's how you got export, investment and domestic consumption aligned up. Today we are in that holding range of 6% GDP growth. Because why does an Indian industrialist want to invest? Because the consumption is still very, very feeble. And that consumption is feeble because, unfortunately, there are no great job creation happening. And we've gone from the $100,000 IT services jobs of the 1990s to maybe a $15,000 Zomato rider today. Nothing wrong, we have to create all these jobs, but we've gone down the value chain in a sense. Even IT went down to GCCs. It's not gone up to making IT products and technology and ownership of IP. But that cannot come until you're part of an ecosystem where you're learning, and then you can start, making your own product. Because we were just not in any of these global supply chains for so long. So, for example, when Maruti came, they kickstarted the whole auto sector in India.
Sure.
Same way I was excited when Apple came, that whole ecosystem will get developed in India, and we can then leapfrog from just being packaging guys in EMS and so on, and then climb the chain. So it won't happen in 1 or 2 years. But over 10 years, you have to be a player in automobile, you have to be a player in defense, you have to be a player in electronics. That's the heart of any manufacturing renaissance. Even today, auto is 50% of manufacturing GDP of our country and most countries.
Sure.
If you're not a player there and you're not part of that ecosystem, there's no way we can cross this 14-15% threshold of manufacturing which we have in India. Our aspiration has been 24, but we've been stuck at this 14-15% range for like, I don't know how many years. So I'm hopeful this redrawing of the chessboard actually helps kickstart this. And that's the most bullish thing you can think about.
Absolutely. And I think that number, right, 80,000, 3,000,
is the game.
We were speaking with this UBS economist in the morning, and there was, her view was, according to her, the biggest risk from all of this, of course, she acknowledged that there are positives and may stand to gain, is that there is so much excess Chinese capacity everywhere, and that kind of now start to go. So, I mean, we need to be on the guard as well here in India, right? So, the fear was that Indian private sector capex, which anyway was kind of not kicking off, I mean, that gets delayed further because, I mean, people will be watching what this capacity does.
It's been one of the reasons why we've not done it so far, because we were worried, and, how does government react to each type? Do we go for anti-dumping and then it takes 6 months and by then you're already on a back foot? But if this sort of alignment does come out, and now government's clearly, got your back on this, and you're expecting this sort of dumping to happen, I think the game restarts. And that's why I'm saying it's a resetting of a lot of assumptions. So a lot of our old assumptions have to be changed, I think, in the next 6 months. A lot of our old assumptions will change, including about how the dollar trades. Like we just keep assuming rupee must keep falling. If this dollar reset has to happen, and I'm sure we'll talk about it as well. I mean, that's part of his game as well, that you have to have a little more competitive dollar.
Welcome back. We're in conversation with Manish Chokhani. We've been, of course, talking about the real economic impact and how perhaps at the margin India does stand to benefit. Manish, thank you for staying with us. I remember the conversation with Neelkan Mishra earlier, and he was saying that for India, the impact is not so much because we are kind of largely closed and we're not. And at the margin, maybe you said you stand to gain, but it's through markets. I mean, the impact is going to be through financial markets. So let's just parse through some of the stuff which has happened, and just start with the bond market in the US. What is as they say, bond vigilantes are back.
Right.
They never went away. But what is the bond market telling you? Yields on the 10-year first fell to 3.8.
And now 4.5.
Now it went to about 7.5, 8, and then 4.5 now. What is the bond market telling us?
Look, the US has 30% holding of treasuries by foreign governments. And with, unfortunately, the way they have gone and kind of rubbed all governments of the world the wrong way, do you think 30% of all the refinancing which is coming up over the next 12, 15 months is going to be attractive to foreigners to come in? At 4.5%, maybe you'll be tempted, but then you'll think, what if this guy confiscates my holding of treasuries? Because they've done that to other countries, which is why you've seen not just the bond yields here, but the flight of capital away this time. Number one has been gold. But it's also gone to euro. The Swiss franc is 1.2 to the dollar or thereabouts, which the Swiss central bank, I remember, was trying to hold it within parity for the longest time. The euro, which is actually, we used to call them the sick man. And Larry Summers had this thing of Europe being the museum of the world. The euro is strengthening because that capital is going back, because they've clearly rubbed the Europeans also the wrong way. So I don't see an alternative for the US government, whenever this refinancing now starts coming up, to go back to anything other than printing. And that's the reason for what you're seeing is happening to gold. and why we think there is endemic inflation in hard assets. So when we talk about markets, the normal trend has been US weakens, money goes to emerging markets and hard assets. What Trump is doing is only accelerating a lot of these trends, which he also does want a slightly more competitive dollar. But if you get this rise in gold, silver, uranium, copper, whatever at one end, and real assets like factories and real estate, it's a decadal move. It's not a 2-month, 3-month kind of move. And I think you'll see substantially higher gold and silver prices. And again, with lower oil, higher gold, again, events seem to be conspiring to
But
play.
this runs contrary, Manish, to what they started out. I mean, they wanted lower cost of borrowing.
Look,
so in that sense, last week has been a defeat.
See, they want to square the circle. You can't have kind of a forced recession in the US, which is what they need to do to crunch the current account. They need to move a lot faster on Doge to get the expenditure side down, which has not been happening at the rate one anticipated originally. Because if you get that expenditure cut and you get some of the income from this tariffs, then you have room for a giveaway, because his next game was, I will pander to my base by saying up to $150,000 no tax. And I will just put a sales tax. And therefore only the rich buggers who are buying stuff will pay for it. So like I said, there are so many moving parts. The world's not sitting idle while US plays the game they want. So people have been reacting, and therefore I think they'll get into a bit of a corner where I think this QE number, whatever infinite number which is coming, at some sense comes again, which is what gives you this inflation in hard assets and emerging markets.
So higher yields, you think, in the US?
Well, US can print its way out. Yeah, and what that just means is your reserves are going to get smashed in real terms, and therefore all the central banks for the last 2-3 years, it's not new, have been running helter-skelter to go and stock up on gold, and the gold number is still very low. Historically, pre the Bretton Woods breakup in the 70s, gold used to be like 60% of people's reserves. They are probably at 15.
Much lower.
So there's big headroom to go here. The younger crowd and the non-aligned crowd may say we want to go to digital currencies, Bitcoin and others. China has already made its digital currency. They've made their own version of SWIFT, which has been spoken about a lot. So it's a dismantling of the old architecture and plumbing of the world, like I said. There's something we were speaking about when we were in the conference together, which Sharad Sharma puts very elegantly, that if you don't own the standards and protocols, you will not be able to build the platforms on top of them. So all you'll be doing is then playing on the application and product layer and maybe the service layer, which is where India has been traditionally playing. China has understood the game and gone down to the depth, where they are setting the new protocols and standards, whether it's for EVs or whether it's for these payment mechanisms, for industry after industry. Like they control a lot of the critical industries of the future, the critical rare earths of the future. And therefore they've gone and built their own platforms. And kept the Americans out from their walled garden, which is why when US says we won't allow you to buy semiconductors, they can still come out with a DeepSeek.
Absolutely.
So I mean that game is still 10-15 years behind, but that's the only way we'll have to go.
Okay, let's talk about equities. Where does all of this leave equities in that sense?
So if whatever I'm saying plays out the way I think it does, it is again a gush of money coming towards emerging markets and hard assets. It's consistent with our markets then having a holding pattern for next at least few months while we figure out what are the new assumptions to plug into our spreadsheets and so on. But post that, there should be a big breakout in emerging markets. The CRB index also looks like it's about to take off. Gold, silver, uranium, you have to go into nuclear and stuff for powering all your data centers and additional power requirements. Europe is going to go into rebuild mode for its defense and its factories and so on, which is again hard assets. So all the old industrial companies which we, I remember I'm looking at some European companies and the names which pop up are like the old used to think of Alfa Laval in America, Ingersoll Rand, and those names look like they're ready to run.
When you say money comes, gush of money into EMs, that is China as well? Or you think it's
So, well, the Chinese government's propping up their own market, and they're very clear they want their market because they need a wealth effect after property got smashed. So the Chinese market is exhibiting great resilience. China performs actually, but what's happened is post the September stimulus which China gave, the global money started going to China. And India was expensive at that point, and that's really the big 30-40% correction we got over here. And most of the Trump correction, I think, is already done, and we are back to where we were. Because I think markets realizing that we will end up on a better side over here. But from a global perspective, if global money is not going to go into China, at least from America, question is which way do the Europeans swing now? Because they are in a bigger mess. They can't do without China, and they don't have the defense which America has. They don't yet have the currency in the world. So if China plays, its cards well with Europe, and India says we are Vishwa Mitra, and we are friendly with America and with China. Chinese market is actually very, very cheap, and they actually are incredible companies and incredible technology leadership in the world over there. So I may not love them as a patriot, but as an investor, you can't deny that countries.
Any sector, banking, financial services has always been something you like. Anything?
So banking is the leader of this this cycle, and the way things are aligning in the world, this sector is, I think, still going to be a very, very large wealth creator. I don't know if I spoke with you earlier. If you take the 2027 numbers, not 26, the numbers of all the banking sector stocks will exceed the erstwhile leadership from the IT sector stocks with greater stability and greater terminal value. And therefore, does the multiple from one sector apply to the other? Because in some cases, we had abandoned this price to book, right? When earlier we used to talk about HDFC or Kotak or Bajaj Finance, we talked in terms of PE multiple and not price to book multiple. Then we went through a phase where we are still talking about price to book multiples. I think the PE scenario will start coming back for a lot of these companies. And then we'll go forward and we'll discover SOTP, that they also have insurance, they also have AMCs and so on and so forth. So it plays out, it's a normal cycle. So just have patience. On balance, we are in good shape as a country. 6% band hai GDP ka. So you're not going to go to 8 suddenly, you're not going to collapse to 4. It's a holding pattern. Until we get this new stimulus coming in, that catalyst is required to kickstart. The government's played its part. You've got the fiscal stimulus.
Last time we spoke, you said you need this exact thing. I mean, you need a new source of wealth effect. And maybe precious metals, I don't know. Is that...
Well, one sector takes off and then that animal spirit spreads. Today,
that is missing.
It's like, the average industrialist is like, should I go in this direction? Should I go in that direction? Will policy change? What will happen? Will I get the support? I think stars are aligning. We just have to be patient, I guess. We can't have a bull market every single day of the year. Sometimes it's good to just pause and reflect after a good meal. 4 years you had a good meal. Just do a detox for a while and then take it from there.
So just to recap this for our viewers, you're saying a few months of holding pattern, ranged market.
I'd hope so.
Yeah, right?
Yeah.
And then and then maybe the market looks more constructive, basically.
Yeah, this market wants to go up. We're not giving them enough reasons because that has to come from earnings. When you're doing a single-digit earning growth, you can't say at 20 PE we're like okay market. Some earnings come and then we're off to the races. And it'll still be very specific. I don't think the tidal move across sectors happen because in typical periods like this, you separate the men and boys as well.
Manish, absolutely great conversation. Thank you very much for your time. Thank you for coming down.
Thanks for having me.
Well, that's it from me. Thanks for watching. Manish Chokhani with his views on global markets, global macros, and more. Thank you.